Hello and welcome to Edison TV. I'm Miłosz Papst, Director of Investment Trust Content at Edison, and today I'm joined by Bill Chater, who's Global Small Cap Investment Specialist at Baillie Gifford. He will talk about the Edinburgh Worldwide and the investment case for the small caps. Bill, many thanks for joining us today.
Thanks very much for having me. It's great to be here speaking to you today.
Maybe you can start by giving us a high-level introduction to Edinburgh Worldwide and its investment approach.
Yeah, of course. So the mission for Edinburgh Worldwide is quite simple when you look at it at its top level. We are looking for the next generation of really great growth businesses. We want to find these companies when they're small, frankly, when they're still to go through some of their most exciting, rapid stages of growth, the formative early stages of growth, if you like. We're looking here for high potential companies, those companies with the ability to disrupt large incumbents, to take significant share of attractive end markets, or occasionally create entirely new end markets. And we're looking for forward-thinking companies which are innovating either through novel technology or business practice to provide solutions which are really observably better than what came before, better than the status quo, and simultaneously cheaper. Now, we would admit that this is a very growth-oriented mindset applied to an asset class which most people approach with a more value-oriented mindset. And we think that that's one of the very distinctive elements of the Edinburgh Worldwide Trust. It's also worth saying that we are fishing in an enormous investable universe. It's hard to get an exact number, but our best estimates place it in the tens of thousands of companies of appropriate size and sufficient liquidity in which we could invest. But quite frankly, most of those businesses don't have the kind of potential we're looking for. It's one of the unfortunate truths about small cap investing, that most small businesses aren't actually that remarkable. Most of them are pretty undifferentiated. They don't have a particularly strong proposition. So we're not interested in those companies, but it does mean that size in isolation is not a great proxy for the type of potential we're looking for. So instead, we've identified 4 traits that we associate with company immaturity relative to their opportunity, and assessment against these 4 traits forms the basis of our investment framework. So we're looking for companies who are utilizing innovation to solve a large problem. We're looking for companies that through that innovation, they are really defining their competitive advantage that we believe over time will solidify, deepen, and hopefully broaden. We're looking to assess the management teams. We recognize that taking a small business from its infancy and scaling it, well, that's not for the faint of heart. You're looking for people with the skill and vision and grit to take the business forward. And then importantly, we're looking for scalability. And that can mean different things depending on the business, but at its most basic level, it means, do the returns become more attractive as the business becomes larger, rather than diseconomies of scale or the law of large numbers taking hold of that company. And importantly, we think these 4 traits, they indicate potential regardless of market cap. So another distinctive element of the trust is its ability to hold businesses as they scale, regardless of size. So although we are looking to take an initial position in companies below $5 billion of market cap, if you look at our current portfolio, we have companies which are scaled far beyond that to kind of 10, 20, 40, over $100 billion in market capitalization. And then finally, I think it's worth saying that the trust has the ability to hold a proportion of assets as unlisted private companies. We can hold up to 25% of the portfolio in that asset class. And for here, we're looking for individual investments, unique companies that meet our criteria, which aren't yet available in public markets.
Great, thank you. Now, as we all know, the US equities market has been driven by a quite narrow set of mega cap stocks. And some investors, at least until recently, considered the upcoming turn in the Fed rate cycle as a potential catalyst for the broadening of the bull run to include US small caps. Would you agree with that?
I think when answering this question, it's probably worth just taking a step back and referencing really everything that investors have had to deal with over the last few years. It really has been a very difficult time. You've had the lingering second order effects from the pandemic. You've had a pretty unclear picture of where we are in the economic cycle, which is persisting particularly at the moment. You've had inflation and then a historically aggressive rate hiking cycle. And bluntly, this environment has been very difficult for smaller companies. These businesses tend to be more rate sensitive. You have a higher proportion of earlier stage businesses which may not yet be generating sustained profits and may be more reliant on external capital to fund future growth. You also have a higher proportion of businesses which have a greater amount of floating debt, which moves with central bank rates and therefore could possibly erode profitability. While the duration of cash flows for those earlier stage companies means that those smaller businesses are more sensitive, their valuations are more sensitive to rate expectations and the implied discount rate. And then kind of coupled with this is, Milos, you've referenced, you've had the theme which has really sucked a lot of air out of equity markets, in our opinion. So that excitement around generative AI and the pretty obvious immediate infrastructure build out that is going to be required to facilitate these services. Now, as investors of smaller growing business, this has been a difficult combination. It's felt like a lot of the risk seeking capital has really been drawn to that generative AI area, along with maybe we could talk about the enthusiasm for Bitcoin and then also the obesity drugs or the anti-obesity drugs, the GLP-1s. And really there's little interest, or there has been little interest and almost, I'd say, a disregard for companies which are at their earlier stage and attempting to build something for the future, which they're attempting to invest in the here and now to develop capabilities and really scale a business over time. Now, we could talk about whether the present enthusiasm for the current tech champions is justified. From our position as smaller companies investing, we admire these businesses. But what excites us as investors is the prospect for future asymmetry, if you like. The prospect of making multiple times your initial investment in these companies. And whilst we admire their past achievements, when we look at our portfolio relative to that, we're frankly much more excited about that potential there for future asymmetry than looking at those behemoths. Now, your original question was around interest rates cycles and whether that could be a catalyst for change. And we don't profess to have great expertise over macroeconomics or great insight when calling rate cycles. With bottom-up stock pickers, we look for the fundamental appeals within individual companies and look to make predictions at that level. Nevertheless, from our perspective, we can still observe that in the past, smaller companies have tended to lead the market when rate cuts have started. And I think that in this instance, we can be optimistic that, again, they will do the same. And that could be a very interesting tailwind for the asset class as a whole.
Great, thank you. Now, obviously, we also need to touch upon the recent sell-off in the markets triggered by some weaker US macroeconomic data, among others. So maybe you can also shed some light on your view on the impact of a potential US recession on US small caps. Yes.
Again, I'll take a comment I made in response to the last question, that we're not macroeconomists, we're bottom-up stock pickers. So we have observations and thoughts regarding the recent moves in market, but there will be other commentators much more clued in and able to give accurate thoughts. From our perspective, it is worth saying that a US recession appears a lower probability event, all things considered. I know we've seen recently weaker jobs data and some weaker signals at the lower end of consumer discretionary, but economic growth and overall consumption looks fairly solid. While yesterday you also saw that the ISM survey, which looks at kind of manufacturing sentiment, came out again representing expansion. So all this to say, despite the recent market moves which hinted at a fear around recession, it's by no means a certainty at this point, and I think we need to consider the likely probabilities on both sides when having this conversation. What we can say, though, is that small caps often get labeled as performing worse going into recession. Now, the context of the composition of the asset class is important here. You look at a smaller company's index, whether it be the Russell 2000 or the S&P 600, and those indices, in comparison to a larger cap indices such as the S&P 500, those smaller cap indices have a lot more or a higher proportion of cyclically exposed industries. So industrials, financials, they have those in larger weights than large cap indices. So just by their composition, it perhaps makes sense that going into a recession, they will perform less well than large cap comparators. But at this point, I'd very clearly emphasize that our strategy looks nothing like the benchmark. I've talked earlier about our growth-oriented mindset, which has really pushed us to investing in areas of our opportunity set, such as information technology and transformative healthcare, areas that we think are seeing the greatest innovation, that are seeing the greatest technological change, but frankly, the most interesting things are happening. And that kind of positioning to us, it also speaks to the benefit of investing alongside powerful structural growth themes rather than looking to take a play on economic cyclicality. You see, structural growth, whilst it's not removed entirely from the drumbeat of the economy, you can still see growth occurring, whether that be by market expansion, channel shift, or share gains prompted by product innovation or novel business practices. And we've seen really kind of pleasing examples of this in our portfolio kind of over the last few years. And it does lead us to be very comfortable with our positioning in this instance also.
Thank you. And can you maybe now discuss the valuation disparity between US large caps and small caps, also in the context of their earnings outlook?
So there's a lot to unpack in this answer. So I will step you through it as best I can. I've kind of already hinted at in my previous responses that we consider the small cap asset class to be extremely cheap at the moment. You can look at this in a number of different ways. You could look at its relative valuation to larger businesses, which is 2 standard deviations lower compared to historical kind of averages. You could look at spot multiples for the small cap asset class in isolation and compare its current value to long run averages and see it's comfortably below that. From where we're standing and based on our work, we don't think the asset class as a whole has looked this cheap at any point in the last couple of decades. And for us, that's quite an interesting anomaly. Now, we've already discussed some of the recent drivers of this within market that have led to this valuation discrepancy, whether that be rates, whether it be the idea that technology is favoring larger businesses. Another facet which is often discussed, and Milos, you've alluded to it in your question, is that larger businesses often have better earnings outlooks, and that's true. I'm not going to sit here and dispute the fact that the large cap asset class has a stronger earnings outlook than the small cap does. But it's also true that you see smaller companies still grow sales faster than larger businesses. And actually, if you look back at the last 10 years, if you look at a US small cap asset class, you've seen that they've historically returned higher amounts of operating and free cash flow. So there are kind of a few different angles you can take to that argument. Again, though, at this point, I will say that we are not looking to own the asset class as a whole. And more than that, I'd argue quite strongly that if you're looking to capitalize upon the current valuation of the asset class, there are still very, very good arguments for looking to take an active approach within the asset class rather than just look to kind of to buy the benchmark. You see, there are a few structural elements particular to smaller companies investing, which to us favor an active approach. Firstly, as I've said in an earlier response, the universe is very large, tens of thousands of companies. But within that, there is a real range of qualities. And additional to this, we have found, based upon our own research, that within the small cap asset class, there's a higher proportion of outlier businesses relative to large cap indices. So if you look at over the last decade, the percentage of companies that have delivered a 5 times return or greater, well, in the last decade, around 10% of companies within the S&P 500 have delivered a 5 times return or greater. But if you take that same analysis and apply it to US smaller businesses with a market cap between 300 million and 10 billion, that value increases to 15%. So yes, maybe the aggregate quality of the US small cap asset class as a whole can be questioned, but within that asset class, there are some really, really special businesses. And it's therefore about having a structured approach to identifying them. And I've already outlined the methodology by which we go about this. The other structural element to touch on briefly is just the coverage within small cap asset classes. It does remain less well covered or more thinly covered than large cap asset classes. So around 80% of US small cap businesses are either thinly, very poorly, or not covered at all, which again it speaks to a more inefficient market, which favors or makes it an interesting opportunity for active management. And I think then to maybe kind of tie this all together, if you like, what's really exciting for us at the moment is that a lot of these high potential businesses, they're getting caught up in the current market aversion to small caps. So you're seeing unique companies with good business models, strong balance sheets are just getting derated. And to us as active managers, this is presenting an opportunity to own these unique assets in greater amounts. So I'm thinking here of companies like Oxford Nanopore in the UK, which is a genetic sequencing business, QuantumScape, which manufactures solid-state batteries, or Schrödinger, which is a healthcare IT business. These are exactly the type of companies which the market is not tolerating at the moment, but to us are intriguing investment opportunities for the long term.
Great, thank you. That's very helpful. And now finally, obviously, you already touched upon the positioning of Edinburgh Worldwide. But maybe you can add to this and maybe shed some additional light on the secular themes you're exploring across your portfolio.
Of course. So I'll highlight 3. I could touch on more, but in the interest of time, I think 3 will give you a good coverage. So healthcare is has been a historically well-represented area within the trust, and it continues to be so. We believe that the convergence of deeper biological understanding, novel technologies, are just unlocking new avenues for treatments and really kind of changing the perception of what's possible. We have a range of businesses within the area. We have some companies such as Alnylam Pharmaceuticals, which are at the cutting edge of developing groundbreaking treatments that will improve patient outcomes for the next decade and beyond. We have other companies which are involved in the production of medical devices. I touched on Star Surgical there, which manufactures implantable lenses for vision corrective procedures. And then we also have a range of companies which are involved in, well, that's kind of decoding biology, if you like, so that we can improve the processes and outcomes through healthcare systems. And the cancer diagnostic business, Exact Science, would probably be the one I'd highlight there. So that's one theme. The next would be, we have a range of companies which are really at the forefront of hardware technology. And it's quite different for a lot of our investors. Some of our investors have been kind of investing for 20 years or so, and they would say that, oh, well, when they started their career, hardware was a bit of a dirty word. It was pretty undifferentiated, low margin area of the economy that really you didn't want to be involved in as investors. But what we're finding is a growing number of companies which are able to fuse distinct hardware with interoperable software to create an overall proposition which is very, very hard for competitors to match, because it's displaying expertise in so many kind of disparate and different areas. The ones I touch on there would be SpaceX, the private space exploration business, which is demonstrating a very attractive competitive position in rocket launch, but also a growing almost global utility business with Starlink, enabling high-speed internet access across the world. And the other one would be Axon Enterprises, which is enabling safety as a service for law enforcement. It has non-lethal weaponry, but also sensors and software to accelerate evidence collection and make it easier for police forces to navigate through that. And then the final of the three I'll just very quickly touch on would be enterprise digitization. And these really are software companies which are helping businesses of all sizes move into the 21st century, doing more with less through software which can take processes and workflows and accelerate them for those companies. So I'd touch on there JFrog, which is a software company which is involved in the fulfillment of software updates. And I think we've all seen with the recent events at CrowdStrike what can happen when a software update goes wrong. And then the other one I touch on would be Appian, which is a low-code bespoke application provider, helps businesses identify and then develop small pieces of code to take workflows and automate them.
Bill Chater, Global Small Cap Investment Specialist at Baillie Gifford. Thank you very much for your time.
Thank you, Milov. You take care.